Warning, what I'm about to say is controversial. It goes against the party line you've probably been hearing from the mainstream media for some time now. Simply put, it's a shift in global energy markets that will result in devastating losses for most investors, while a few who recognize the changes that are already underway could generate tremendous wealth. I know you may not like what I'm about to tell you, but it's not political and I really have no agenda. So before you dismiss me as some sort of crank, I urge you to watch this short video presentation through to the end and then decide for yourself. Hi, my name is Elliott. I'm co-founder of Energy and Income Advisor, an energy-focused investing service I started more than 9 years ago now that's quickly and quite quietly grown to serve thousands of investors around the world. And what I want to tell you is this. Simply put, the so-called energy transition is dead, at least in the form currently recognized in the mainstream media and by most investors. Let me be more specific. The widely touted idea that oil, natural gas, and yes, even coal are quote-unquote dead fuels that will quickly be replaced by clean, renewable energy technologies like wind and solar. The idea that the internal combustion engine will be phased out by 2030 or so and replaced by electric vehicles. These ideas have been completely and entirely discredited. Listen, I know that might seem like heresy in light of all the talk about ESG and socially responsible investing. However, I promise you, as I'll explain in just a moment, the signs are already there for all to see. And just over the past 3 or 4 months, global markets have started to shift definitively away from energy transition investing themes. Governments have already fallen, and more will fall over the next 12 months or so. The only reason this generational shift isn't getting more attention is that the status quo has become so accepted and so ingrained in the media, in popular culture, and political narratives that most are unwilling to challenge these accepted notions. However, if you step back and consider the research I'm about to show you in this short presentation, you'll see my conclusions are inevitable and the consequences are both vast and severe. Take a look at this chart. This chart shows 3 different natural gas price benchmarks: Henry Hub on the US Gulf Coast, the Netherlands Tidal Transfer Facility in Europe, and the Japan-Korea LNG Cargo Index, all since early 2020. US gas prices are pictured in blue, the Japan-Korea Asian benchmark in orange, and the Netherlands TTH benchmark in red. Now, US gas prices have risen over $6 a million BTUs this fall, the highest level since 2008. However, what's truly shocking is the surge in European and Asian prices this year. The key Netherlands TTF benchmark reached highs above $40 a million BTUs in early October, a record high and up about 6-fold from where European gas prices were trading back in early January. That's also about 7 times the cost of natural gas in the US in early October. In Asia, prices jumped to highs over $35 a million BTUs in the middle of October, more than 6 times the cost just 6 months earlier. So you might be wondering, what's causing this unprecedented surge in European natural gas prices? Well, to put it simply, soaring European gas prices are the direct result of the region's failed efforts to force a rapid transition from traditional sources of energy like oil, coal, and natural gas in favor of renewables like solar and wind. Again, I know that Europe is widely portrayed as the most successful region in terms of meeting its targets to reduce carbon dioxide emissions by 2030. The region that's furthest along in the quote-unquote energy transition away from fossil fuels. However, when you examine the facts and evidence as I have, I believe you'll see that popular, widely repeated narrative vanishes to be replaced by an increasingly grim and dangerous reality. Let's take Europe's largest economy, that's Germany, as an example. Take a look. In 2020, about half of Germany's electricity generation came from renewable energy, including 27.4% from wind, around 10% from solar power, 9% from biomass, and 4% from hydroelectric power. Nuclear power chipped in an additional 12.7% of Germany's energy needs, while coal accounted for almost 1/4 of the country's power, and natural gas about 12%. And just so you can see how that's evolved, let's go back to 2015, and that's just 5 years ago, and take a look. It's not hard to see how Germany's power mix has changed and has grown increasingly reliant on solar and wind power. In 2015, coal accounted for almost 45% of Germany's power generation, while wind and solar chipped in just 14.8% and 6.7% respectively. So you might be wondering, isn't Germany the great success story for the entire energy transition away from dirty coal to clean renewables like solar and wind? Well, yes and no. You see, I have nothing against solar and wind power per se. In fact, I believe both will become important sources of global energy supply in coming years. And clearly, Germany's energy policy of aggressively supporting the development of wind and solar power has resulted in a truly massive build-out of wind and solar capacity. Renewables have displaced nuclear power, which Germany is scheduled to completely phase out over the next few years, and coal, which has seen its share of the German power stack plummet by about 20 percentage points over just the past 5 years alone. However, there's a huge problem. Again, I know this is going to sound like heresy to some of you, given the narrative out there in the mainstream media. However, the dirty little secret is that wind and solar power are just not reliable. You see, power generation from wind and solar facilities ultimately depends on one of the most variable forces on Earth, and that's the weather. When it's not windy, power output from wind power facilities will decline dramatically. And when it's cloudy, solar power output will inevitably drop. Problem with that is that the timing of these spikes and lulls in power generation isn't always convenient. You see, when it's hot in summer, it's often caused by the presence of a high pressure system, which also tends to result in a decline in average wind velocities. In short, power demand for air conditioning systems spikes, just as output from wind power facilities dips. And just consider a normal workday. People come home from the office and start using more electricity to run heaters or air conditioners or to turn on the television or the electric stove. All that happens just as evening approaches, sunlight fades, and power output from solar facilities declines. The problem is that while it is possible to store power, there is no cheap way of doing so for long enough or on the scale needed to meet electricity demand for a country like Germany, and certainly not the United States. Don't just take my word for it. Take a look at the mix of wind, solar, and other power sources in the German energy grid since the middle of last year. That's 2020. In particular, look at the black line on this chart. That's German wind power output in megawatts. Look at how wind power output declined dramatically starting here in October 2020, straight through the winter months, the spring months, and into the summer of 2021. In fact, in October 2020, wind accounted for a whopping 30.9% of total German power generation, plummeting to a low of 11.43% of the German power supply in June 2021. As I showed you a little while ago, Germany has aggressively expanded wind power generation capacity over the past 5 years. So this decline is entirely due to lower than average wind velocities across much of Europe in the first 9 months or so of 2021. So what do you do when you lose your most important source of electric power? Do you deal with rolling blackouts? Do you demand or encourage consumers to use less power? Well, good luck with that. You could try those moves, yet they would be unpopular to say the least, and could have severe and somewhat permanent economic ramifications, especially for an economy just recovering from coronavirus-related lockdowns. So what Germany did was to step up its reliance on fossil fuels for electricity generation. In June 2021, for example, when German wind power reached its lows so far this year, the dirtiest power source of all, and I'm talking about widely vilified coal power, accounted for almost 30% of German electricity supply. Meanwhile, even as European natural gas prices started to take off last spring and through the summer, as I showed you earlier, Germany could not decrease its reliance on expensive gas-fired power, not if the nation wanted to keep the lights on. The result? Well, see for yourself. This chart shows German baseload electricity prices so far this year. As you can see, prices soared 350% between the end of 2020 and early October of 2021. Power prices in Europe's largest economy recently soared to a record high, surpassing the level reached at the height of the 2008 energy crisis, a time when Brent oil prices breached $147 a barrel. And they were up more than 40% from that prior record high. And just remember that Germany already has the highest household power prices in Europe at nearly 32 euro cents, which is about 37 US cents per kilowatt hour. Now let's put that in perspective. The US average residential electricity price is just under 14 US cents per kilowatt hour. All that said, this isn't uniquely a German problem. You see, Europe as a whole has followed the German lead here, encouraging the rapid adoption and development of intermittent renewable power sources, mainly solar and wind, and like Germany, that's rendered the region more susceptible than ever before to weather-related issues. Moreover, again like Germany, these policies have led to higher electricity prices and the need to maintain significant what's called shadow capacity. And these are idle natural gas-fired power plants that can feed in electric power when the wind isn't blowing and the sun isn't shining. Of course, Europe is the only major region that appeared on track to meet its goals for reducing carbon dioxide emissions over the next few years. So some might argue that these costs are worth it. However, even as world leaders gather in Scotland for the COP26 Climate Change Conference, European resolve for its climate goals is showing clear, deep cracks. Eurometaux, a group that represents some of the world's largest metals companies, recently sent a letter to the European Commission warning that surging power prices right now are forcing producers to curb production. The group also noted that the region's energy crisis threatens to derail the bloc's green energy push and force some companies to relocate operations away from the European Union. The letter urged the EU to take steps to ensure that emission allowance prices don't rise too far, too fast. And Spain's government also sent a letter to the EU on September 20th, stating that measures aimed at reducing carbon emissions, quote, may not stand a period of abusive electricity prices, end quote. You see, this autumn, Europe was slated to continue discussions over policies needed to meet the region's target of reducing greenhouse gas emissions 55% by 2030 compared to 1990 levels. Measures under consideration include a ban on new internal combustion engine cars, contemplated to start as soon as 2035, as well as additional emissions credit charges. The current power crisis prompted the cancellation of a planned gathering of EU environmental ministers in September. Instead, on October 6th, the same group met to discuss how soaring consumer energy prices impact the region's green energy transformation goals. However, the only thing that's actually dented the rise in European gas prices this month is news that Russia plans to increase exports to the EU ahead of the winter heating season in an effort to boost the region's desperately inadequate natural gas storage position. Of course, Russia accounts for about 40% of the European Union's natural gas supply, so the region's increased reliance on renewables also implies a massive loss of energy independence. The hard truth is this: whenever weather conditions are unfavorable for renewables, Brussels will go begging to Moscow or face a long, cold, and potentially deadly winter. Some might even argue that extreme electricity cost inflation even helps explain why German voters handed the climate chancellor, Angela Merkel, her party, her center-right Bloc party, its worst election showing since 1949. Listen, Europe's energy crisis is bad news, and it's already having severe political, financial, and societal consequences. However, I must warn you, I think there's a looming trend out there that's even worse. It's a trend that will also likely have a far more direct impact on Americans and investors like you and me. Let me explain. Recently at the COP climate conference in Scotland, President Biden had this to say about soaring oil prices of late, and I quote, "I do think that the idea that Russia and Saudi Arabia and other major producers are not going to pump more oil so people can have gasoline to get to and from work, for example, is not right." Look, there's nothing at all unusual about an American president blaming OPEC for rising oil prices and urging the group to increase supply and drive down those prices. It's a politically popular move, and it has been used by leaders of both major U.S. political parties. However, as I'll explain in just a moment, the root cause of the recent jump in oil prices, and that's to the highest level in about 7 years, it goes far, far beyond OPEC production policy. In fact, it's the leading edge of a dangerous trend that's directly related to the misguided energy transition timetable I just covered. It's a dangerous runaway bubble that's been further fed by the policies of the U.S. Federal Reserve and other central banks around the world. And when it pops, as all bubbles eventually do, the consequences could be devastating if you're not prepared. However, before I get into all that, let's just step back for a second and consider that President Biden just urged OPEC to pump more oil while attending a conference aimed at discussing ways to wean the global economy away from fossil fuels like oil and natural gas. Now, one of Biden's own aides attempted to clarify the U.S. stance on OPEC and this energy transition, saying that the U.S. hoped to see production increase in the short term, but stands by its longer-term goal of continuing a transition to be more reliant on renewable energy sources longer term. Well, you see, that in a nutshell is the problem. For some time now, the U.S. and many foreign governments have been focused on adopting policies and mandates aimed at reducing the importance of fossil fuels. Many governments have announced a phase out of internal combustion engines entirely. Others have put a price on carbon emissions or subsidized alternative energy sources like solar and wind. And many have offered tax subsidies or other incentives for buying electric vehicles. Meanwhile, here in the U.S., the Biden administration recently put a halt to new drilling permits on federal lands, while several key pipelines that have been proposed in the U.S. have been killed by environmental activism or by the courts. The aim of all this, in one form or another, is to reduce the appeal of investing in new energy projects to produce, move, or store oil and gas, while increasing the financial appeal of renewable energy projects. Well, global energy companies have heard the message, and capital spending across the global energy supply chain has collapsed in recent years. Take a look. This chart shows total capital spending in the energy industry since 2010. Much of this CapEx is directed at oil and gas exploration and development activity. I've divided this chart up into two pieces: the integrated energy producers like ExxonMobil, BP, and Shell, and the North American exploration and production companies, which are primarily focused on shale developments. In total, I've included data from 16 major integrated producers and 34 North American E&Ps. As you can see, capital spending from these companies was around $430 billion per year back in 2013 and 2014, yet this year, total CapEx is expected to be just $204 billion. And the early read is that figure isn't going to rise much in 2022, despite soaring oil and natural gas prices. So let me ask you this. Is it really any wonder that according to Rystad Energy, global discoveries of new oil and gas fields worldwide have dropped to the lowest levels since the 1940s? Global producers are finding less oil and gas these days than they have in 70 years. Some of the capital spending cut was clearly driven by the collapse in oil prices that started in late 2014 and a desire to preserve cash. However, particularly recently, we've also seen many of the large European producers de-emphasize fossil fuels and focus more attention on renewable energy investments. Shell announced a plan to reduce carbon intensity by 20% by 2030 and 45% by 2035. Equinor aims to achieve net zero emissions by 2030, and French oil giant Total looks for a 40% reduction by 2030. Regardless of whether one thinks that's a logical goal or not, the practical implication is that over the next decade or so, production of fossil fuels, oil and gas in particular, for most of the European majors is set to decline significantly. At Shell's Investor Day presentation back in February, for example, the company noted that about 42% of its cash capital spending last year was spent on traditional upstream energy projects, production of actual oil and gas. But that upstream share of Shell's budget is set to decline to 25 to 30% of the total budget after 2025. Meanwhile, after 2025, the company contemplates spending 35 to 40% of its total capex budget on what it calls growth projects, essentially renewable energy. The balance would be spent on transition energy, including integrated natural gas production projects. The end result of all that is that Shell's latest strategy update contemplates an annual decline in the company's oil production of between 1 and 2% per year through 2030. That may not seem like a lot to you, but that's a roughly 16% cumulative decline in total crude oil production by 2030 at the midpoint of that guidance range. So at this point, you might be wondering, sure, in the short term, the world will still need more oil and gas, but maybe it makes sense for producers to cut their spending on new projects if they think that global demand will begin to decline in the next 10 years. After all, shares of energy transition stocks like Tesla have dramatically outperformed traditional energy stocks in recent years. The iShares Global Clean Energy ETF, for example, has outperformed the S&P 500 Energy Index by more than 225 percentage points in the past 5 years alone. Those are both good points, and it's something I want to address right now in this video. Let me show you a research paper recently put together by the Swiss Finance Institute. It's a paper that's been making the rounds on Wall Street trading desks, and it's beginning to garner some attention from money managers and traders. Simply put, this paper deals with the rapid growth and popularity of ESG investing. ESG is an acronym for environmental, social, and governance. Simply put, ESG investing moves beyond traditional financial fundamentals to consider factors like carbon emissions, water resource usage, gender equality, and the composition of corporate boards. The idea is that modern investors want to do well by doing good, and therefore want to take these factors into consideration when formulating their investment goals. Listen, whether you believe ESG is a good thing or downright ridiculous, one thing is for certain, it's been very, very popular. In the first quarter of this year, for example, over $180 billion flowed into ESG-focused sustainable mutual funds and ETFs, and such funds now account for more than $2 trillion under management globally. Far more money than that has been poured into actively managed funds that incorporate, to one degree or another, ESG factors and metrics in their investing process. So what this Swiss study did is to attempt to evaluate and quantify the impact of a $1 investment flowing into an ESG fund rather than the same investment in a broader market portfolio tracking an index like the S&P 500. And what the author found is that there's actually a very powerful multiplier effect. Withdrawing $1 from a broad market portfolio, investing it into an ESG fund, actually increases the value of the more limited number of stocks with strong ESG scores by $2 to $2.50. Further, this paper goes on to show that outperformance of ESG funds in recent years and the dramatic increase in market capitalization of stocks that rank favorably on ESG metrics is due entirely to fund flows in favor of ESG investing, rather than, for example, improved fundamental performance. Put in a different way, ESG-focused funds and high-taste ESG stocks would have dramatically underperformed the market were it not for a steady, powerful flood of funds poured into these investments over the last few years. So you might be asking, why can't this strong fund flow in favor of ESG continue? After all, if modern investors really do want to do well by doing good, then won't they continue to favor ESG-flavored stocks and mutual funds? And won't they continue to put their money there rather than into broader market ETFs or energy-focused funds? Sure, that could happen, at least for a time, but I want you to consider two key points. First, one definition of a financial bubble is a situation where the market value of an asset like a stock or a bond, increases far beyond what the fundamentals support. In effect, that's why in 17th century Holland, the average price of a single tulip bulb was worth more than the average annual income of a skilled worker at the time. And some varieties were worth more than a large home. It's also why stocks like Pets.com were valued in the billions of dollars in 1999, only to be forced into bankruptcy just a few months later due to lack of adequate cash flow. And it's why once large, well-respected U.S. mortgage finance companies like Countrywide Financial collapsed back in 2008 as real estate prices fell and mortgage credit evaporated. All of these busted bubbles are examples of when investors poured money into specific asset classes, tulips, .com stocks, and U.S. residential real estate for many years, driving up prices beyond levels supported by traditional fundamentals. History shows the music always eventually stops. Those bubbles I just outlined burst suddenly and spectacularly once the steady influx of funds, monetary investments, slowed and then ceased. So I ask you, if the performance of ESG taste stocks and funds have been entirely or even partially driven by strong flows into ESG investments, is it much of a stretch to say that any slowdown in those fund flows could lead to a dramatic correction? Or put another way, do you really want to bet that historic investment flows into one particular asset class can continue indefinitely? Something that's unprecedented in financial history? And second, since the financial crisis of 2007 to 2009, the U.S. Federal Reserve and other central banks have increasingly relied on non-traditional policy tools like quantitative easing to stimulate the economy. Take a look. As you can see, between late 2008 and early 2015, the U.S. Federal Reserve alone bought more than $3.6 trillion worth of Treasury and mortgage-backed securities in an effort to help the economy and credit markets recover from the 2007 to 2009 Great Recession and financial crisis. Then, starting in February of 2020, the Fed turned again to quantitative easing in an even more dramatic fashion. Between the end of February 2020 and today, the Fed has purchased about $4.4 trillion in Treasury and mortgage-backed bonds in an effort to stimulate the economic recovery from the coronavirus lockdown recession of 2020. Today, the Fed has more than $8.5 trillion worth of these assets on its balance sheet. So while we can argue as to the degree of the impact, it's widely accepted that some of this flood of liquidity ends up leaking out of the real economy and into other markets, bidding up the price of financial assets like stocks and bonds. In particular, the start of quantitative easing in late 2008 and a prolonged period of near zero interest rates here in the US and in Europe also corresponds to a period when growth investments, particularly large cap technology names, have inflated in value relative to pretty much all other sectors of the economy. That's because financial history confirms that low interest rates and super easy money tend to inflate market valuations and, in particular, increase the value of companies with limited near-term earnings prospects but high perceived growth potential, overvalue stocks with high earnings right now but more limited longer-term growth prospects. Well, many of the most popular ESG taste stocks are also growth names. So my research suggests it's very likely that some of the flood of capital into ESG funds is a direct result of super easy monetary policy from the Federal Reserve and other central banks. And now that the Fed has announced plans to taper quantitative easing and has signaled a growing likelihood that it will raise interest rates in 2022, some of that liquidity flood is starting to dry up. Could that be the pinprick that finally deflates the ESG bubble? Well, no one can say for sure, of course, but financial history is replete with examples of bubbles that burst soon after monetary conditions began to tighten. And that brings me to one final and particularly dangerous consequence of the great ESG bubble of the past few years. You see, while ESG flavor stocks have increased in value dramatically, the flow of capital into ESG funds have also starved the traditional energy sector of capital, since oil and natural gas companies do not tend to score well on ESG metrics. Look at this chart. Back in the summer of 2008, energy stocks accounted for more than 15.5% of the total value of the S&P 500. As recently as late 2014, the group still carried an index weight of more than 10%. However, today, the energy sector's weight in the S&P 500 stands at less than 2.8%, barely above its all-time low weight of around 1.8% in late 2020. So let me ask you this. Is oil really that inconsequential to our economy when it still accounts for more than 90% of global transportation demand? Do you think that U.S. consumers regard energy prices as unimportant and are therefore not concerned with the dramatic increase in gasoline prices over the past year? Well, the realities on Main Street and at the ballot box would suggest otherwise. A recent poll by market research firm Numerator showed that 79% of Americans are concerned about the recent rapid rise in prices for essential goods and services, while only around 48% say they're highly concerned about COVID-19. And while there were a number of issues on voters' minds, it's pretty clear economic issues and concerns about inflation were a major reason for the Republicans' stunning win in Virginia's race for governor. After all, the economy was cited as the most important issue for 1/3 of voters in a Washington Post exit poll, with the Republican candidate besting his Democratic opponent by 11 percentage points by voters citing the economy as their top issue. For reference, Joe Biden bested Trump in the 2020 presidential race in Virginia by more than 10 percentage points. And most voters continue to see the energy transition as impractical. A recent Rasmussen poll showed that only 1/4 of Americans believe electric cars are a practical alternative for most Americans, and 53% of those surveyed believe that a Green New Deal type of climate change legislation would end American energy independence. Senator Joe Manchin of West Virginia, who is the main holdout in the Democratic Party for President Biden's centerpiece fiscal spending bill that includes significant energy and climate-related pieces, has repeatedly cited high inflation as a core reason why a bill of that scale is irresponsible at this time. Several polls show that most American voters agree. Listen, as I've said, I do not want to make this political. Personally, I care deeply about the environment. I'm involved with efforts in my home state of Florida to improve water quality, protect our precious marine resources, and the Florida Everglades. However, I firmly believe that indulging fantasies, promoting alternative energy and energy transition timetables that are already proven to fail miserably, and stoking wealth-destroying inflation, none of these are viable policies. And it's clear that Germans, Americans, and consumers from countries across many different regions of the world have their limits. They won't accept ever-rising energy prices that erode their quality of life, and they won't accept ever greater dependence on countries like Russia and Saudi Arabia for basic energy needs. In Germany, voters have clearly begun to recognize the failure of their renewable energy experiment. According to a recent study in Forbes, by 2025, the nation will have spent $580 billion to make its energy twice as expensive as in neighboring France and almost 10 times as carbon intensive. The writing is on the wall, and the energy crisis is here, in Europe, in Asia, and even on the shores of the world's largest producer of oil and gas, and that of course is the United States. Due to nearly a decade worth of underinvestment in oil and gas projects, amid a steady increase in global energy demand, there simply isn't enough supply to meet demand over the intermediate term. The hit to demand from the coronavirus outbreak and related travel mandates and restrictions temporarily hid that fact and resulted in the illusion of a glut. But it's now clear. My research confirms that in just the next 6 to 12 months, OPEC's spare capacity, the world's only oil supply cushion, will shrink to levels where there's historically been a price panic in global oil markets. And when the real building energy price supercycle becomes apparent, the sector will no longer account for just 2.8% of the S&P 500. We're approaching an inflection point for investors as well. Over the past 12 months, the S&P 500 Energy Index is the top performing sector in the S&P 500, up 56.8%, more than double the 25.8% gain in the S&P 500, and almost 20 percentage points higher than the 28.4% gain in the S&P 500 Information Technology Index. So let me ask you, how much longer will portfolio managers be willing to underweight the market's best performing group while piling money into clean energy funds that have actually underperformed the S&P 500 over the past year? When that flow of funds shifts, even by 1% or 2%, my research suggests you could easily see some energy stocks more than double from their current values. So I ask you, will you act now to both protect and grow your wealth amid this looming energy crisis? I hope so. And that's why I've created this video presentation today. Not only to discuss what's already happening, but even more important, to outline in the simplest terms possible a handful of specific profit moves I'm recommending to readers of my Energy and Income Advisor service right now. Profit step number 1, buy the energy contrarians. Listen, as I just outlined, there's been a tremendous wave of investment in alternative energy, clean tech, and ESG flavored companies over just the past few years. While most traditional energy companies have dramatically slashed their capital spending on new oil and gas projects, leading to a collapse in new field discoveries and acceleration of the global base decline rate. But there's a big difference between the words most and all. You see, a handful of energy companies of all shapes and sizes have actually taken advantage of the decline in energy prices starting in the middle of 2014. They've taken advantage of the lack of interest in new oil and gas field exploration and development to go the other way. While most have dramatically cut capital spending and planned a gradual decline in oil and gas production, these companies have ramped up spending and are, over the next few quarters, bringing brand new oil and gas production projects on stream. Even better, due to the lack of exploration and development activity, these contrarian producers were able to negotiate rock bottom prices for key oil field services used to explore for and develop new fields. And they've been able to strike sweetheart deals with governments, with countries all over the world that have significant oil and gas reserves, allowing them to recover the development cost of these projects at a rapid pace and begin enjoying an unprecedented flood of free cash flow over just the next few years. That's free cash flow they're using to pay dividends, pay off debt, and buy back stock to create real value for investors like you and me. These companies may also be one of the only things separating the United States and global economies from a devastating hydrocarbon supply shortfall over just the next few years. Their competitors will be scrambling to catch up over the next few years. And that brings me to this, profit step number 2, the short cycle. The most important development in the oil and gas sector over the past decade has been the rapid development of shale oil and gas fields, particularly here in North America. Shale has transformed the U.S. from the world's largest energy importer, entirely dependent on OPEC and Russia for supply, to the world's largest producer of both commodities. For most of the past decade, the shale industry has been a financial basket case. While producers have managed to increase output, they haven't been consistently profitable or free cash flow positive. Shale producers spent more than they generated in cash flow and created little or no real value for investors over the long haul. Most offered little or no dividend, no share buybacks, and a growing pile of debt. Enter the Shale 2.0 model. Right now, I'm tracking a handful of shale producers in the U.S. that have adopted a new business model focused on cash flow over production growth. The best of breed can run their businesses and generate positive free cash flow even with oil at just $30 a barrel. With oil at $50 a barrel, these best of breed names can pay dividends in the mid-single digits and pay off their debt entirely over just the next 2 or 3 years in some cases. And at current prices closer to $80 a barrel, my research suggests that some of these names will fund their businesses, pay down debt, and offer dividend yields of 10% or even 15% in 2022. The best part of all, these massive dividend income streams are increasingly assured by new, transparent dividend payout schemes that offer shareholders returns directly tied to financial performance and commodity prices. The only catch is that once investors see the dividends these companies will generate by early next year, I expect most of my favorites to vault higher in price and for the best opportunities to be completely picked over. And there's more. Profit step number 3, energy technology. The energy industry goes far beyond producers. I'm currently recommending my readers buy a handful of energy technology companies that own the key technologies needed to produce more oil from aging fields and to optimize production from complex, tough-to-tap reserves. And how about profit step number 4, alternatives the right way? Friend, colleague, and Energy and Income Advisor co-founder Roger Conrad has been covering the U.S. electric utility industry since the 80s and the global energy industry for nearly as long. He's seen it all, energy booms, busts, bubbles, and fads. And he is just as concerned as I am about some of the faddish, bubble investments in alternative energies that are so popular these days. However, he's identified a small group of unsung alternative energy stocks that are generating real profits and in many cases serious dividend income by investing in alternative energy technologies. Alternative energies that aren't entirely dependent on government largesse, capital market bubbles, and unrealistic energy transition timetables for success. In short, doing well by doing good doesn't have to mean forgoing real financial returns and dividend income in favor of the ephemeral, grateful theory of momentum investing. Profit step number 5, irreplaceable assets. And last but not least, you've probably heard or read about the cancellation of key U.S. oil and gas pipelines in recent years. Pipelines that would deliver natural gas from Appalachia to the gas-hungry Northeast. Pipelines that would deliver vital oil supplies from the Bakken shale to the U.S. Gulf Coast. Energy infrastructure has become more of a political football than ever before. However, when you can't build more of something, whether it's cars, machinery, or in this case, absolutely economy-critical energy infrastructure, the value of existing infrastructure increases dramatically. That's why Roger and I are so excited about a handful of out-of-the-favor energy infrastructure stocks that control the vital means of transporting and storing increasingly valuable energy commodities. So there you have it. We've covered a lot of ground in this video presentation today. I've explained why the recent sharp rise in European natural gas and electricity prices is due to the undeniable failure of the region's alternative energy push. Why weather-dependent solar and wind power technologies cannot replace the need for reliable natural gas, coal, and nuclear power plants for the foreseeable future. Why the timetable of rapid energy transition away from fossil fuels in favor of alternative energy technologies has failed and failed miserably. How voters and consumers in Germany, Spain, Poland, and the United States are increasingly bristling at the dramatic rise in energy prices of late, and it's beginning to topple once popular governments at all levels. I've explained how a dangerous bubble in ESG investments, coupled with well-meaning but unrealistic government policy initiatives, have starved traditional energy producers of capital, leading to a fast-emerging shortage of oil and gas supply over the next few years. An energy crisis that's feeding inflation rates we haven't seen in the developed world in 50 years, and destroying the purchasing power of our savings and investment dollars. I don't have a specific political agenda. Rather, I'm just following the facts, and I believe my conclusions, while downright terrifying in many cases, are inevitable. I've also outlined 5 specific profit steps I'm recommending my readers take, starting immediately, to protect and grow their wealth through the coming energy crisis. Just remember, in the last inflationary energy crisis back in the 1970s, the average investor in the United States saw negative real returns from the broader market indices. Investors in faddish growth stocks lost their shirts. Only the handful of prescient investors who recognized the budding crisis, rejected unrealistic, quick inflation fix fantasies, and invested accordingly were able to build real wealth. I'm so confident in my conclusions that I'd like to invite you to review all my research and specific energy stock and ETF recommendations with absolutely no risk or obligation as part of a limited time risk-free trial to my Energy and Income Advisor publication. I'm not asking you to commit to anything today. Simply click the button next to this video to start your risk-free 90-day trial. Each month you'll receive 2 detailed issues of Energy and Income Advisor that highlight specific trends my colleague Roger Conrad and I are following in the energy markets. We also offer updates to our model portfolio stock recommendations that include specific advice on which stocks and ETFs to buy, how much to pay for those stocks, guidance on suggested position sizes, and of course advice on when to sell. Plus a constantly updated list of dangerous stocks that appear to offer the allure of sky-high dividends, but are really just income traps that will burn most investors. And every month you'll also receive an exclusive invitation to our monthly online Q&A chat. It's the most popular feature of our service. Simply put, you'll be invited to ask any questions you like about the markets, energy prices, or specific stock recommendations. And Roger and I will answer those questions live on the monthly chat, providing a transcript in convenient printable PDF format of all your questions and our answers following the conclusions of the chat. In short, try all of what Energy and Income Advisor has to offer for the next 3 full months and only then decide. If you don't agree, it's worth every dime of the subscription price. Simply call us and cancel your membership for a full refund of your subscription price with no questions asked. I guarantee it. And as part of this special limited time offer, and only through this website, I've decided to offer a special bonus absolutely free of charge. And that's a 12-month subscription to my popular Creating Wealth publication, which is a $299 value, absolutely free of charge. Creating Wealth is a twice monthly online publication delivered via email that includes my latest market and economic commentary, specific stock recommendations drawn from all sectors of the market, and a model portfolio complete with specific stock recommendations, advice on recommended position sizes, and my exclusive risk management methodology. And if you're already a member of Creating Wealth, I'll extend your existing membership by a full year free of charge as part of this exclusive limited time offer just for giving Energy and Income Advisor a test drive. The only catch, this deeply discounted risk-free membership offer to Energy and Income Advisor at $649 per year, the lowest price we've offered in more than 7 years. The 90-day risk-free trial, plus a free bonus 12-month membership to the Creating Wealth Advisory Service. I simply can't afford to extend this offer for long. And once it's gone, once I take this video presentation down, it'll be gone for good. And frankly, with energy prices and inflation increasingly in the news, I just don't believe the values I'm seeing today will be available for much longer. So I urge you to accept this deeply discounted risk-free trial offer to Energy and Income Advisor today before it's too late. I know in my heart it will be the best financial decision you could make. To start your risk-free trial today, simply click the button next to this video presentation or give us a call toll-free on 1-877-302-0749 between 9 a.m. and 5 p.m. Eastern Time, Monday to Friday, to subscribe via the phone. Thanks for listening, and here's to your wealth. To start your risk-free trial today, simply click the button next to this video presentation or give us a call toll-free on 1-877-302-0749 between 9 a.m. and 5 p.m. Eastern Time, Monday to Friday. Thank you very much again.